All right, welcome Cayenne to week 3, this Labor Day edition of our finance class. Hopefully, and it sounds like things are going a little bit better for you and your health, and so I'm excited for you. I realize that there are probably still some challenges coming down, and I also understand that there were some computer issues this last week, but I am optimistic to see your assignments and work completed this week to get on track, to get caught up. If you get stuck at any point, please let me know sooner than later so we don't get caught in week 4 and find ourselves too late to get everything caught up. You had such a strong start. I don't want to see that get wasted, so be sure and let me know right away if we come across any challenges or get hung up on any of the assignments or anything like that. This week's assignment is another segment of short answer questions at the chapter end. So just have to go to chapters 8, 10, and 12, which are the assigned chapters for this week. Again, that's 8, 10, and 12. We're not going in order now. We're skipping around a little bit. So make sure that you've got the right chapters. And it gives you, if I'm not mistaken, the page numbers and the numbers that are due. So should be in great shape, but just double check those. And like I say, don't necessarily go in order from what we've done in the past, or that might get you off a little bit. So tonight we're going to talk about 8, 10, and 12. We're probably going to have time during this recorded session to discuss the main points that I want to get to in 8 and 10. All 3 of these chapters kind of get into the weeds with examples and with some of the math. I'm not going to do that on any of them as far as the session is concerned, but I'm happy to go over those with you at some later time, one-on-one if you'd like to. I will also send you the slides after the class is over tonight. If I don't, just let me know and remind me. I'll get those out to you so that you have those examples to refer back to if you need them for the assignment or the assessment this week. Of course, we will spend the last few minutes of the class tonight going over the assessment as we always do. The assessment this week is a smaller one, 25 questions, 50 points total. So about half as many questions as last week's test, although last week's midterm had a lot of repeat material. This week's assessment is only over the chapters that we covered for the week, so 8, 10, and 12. And then next week, just as a quick preview, of course, we'll have the final exam, and the final exam is comprehensive over all the chapters that we'll cover. We'll spend a good chunk of the time next week, as much as half of the time next week, going over the problems that you need to be ready for, at least the topics anyway, like we usually do, and giving you those topics so you know what to look for before we get to the final. The final has a lot of repeat questions, so if you felt comfortable with the test to this point, you should be in great shape. It'll just require a brief refresher, before you get to that final exam. Then, of course, next week we have that little 15-point, segment of I think 3 or 4 questions about course feedback. So a little graded feedback module. But other than that, it's just the final. So no, this is our last week for discussion board and assignments in this class. So like I say, great week to get caught up so that we can focus entirely all our efforts and energy next week on the final. The final is worth enough points where we want to be able to focus and hone in on just the final and the material that we need to know for the final for that test. I'm a little scratchy today. I spent the weekend in Arizona going to the BYU football game, so I must have yelled too much. I feel like I've got a frog in my throat. I'm not sick, but and I feel great, but that's why the voice sounds a little strange tonight. Hope you're having a good holiday weekend. Hope you had a nice day today to relax and to be with family. Most professors will not teach on holidays. With where it's just you, Cayenne, in this class, I thought, well, let's just get it done and have the recording there for you to reference whenever you need to this week, as soon as you'd like to. I'll have it posted tonight, and you'll be able to refer and reference that, as soon as this evening if you'd like. Okay. So as I mentioned before, we're looking at chapters 8, 10, and 12. Discussion board should be pretty straightforward. We've got a 50-point test that's just over the material for this week, and we've got some chapter and questions for the assignments. Once again, if you get stuck on any of it, let me know. But I'm anxious to see the past work, Cayenne, that we get caught up on that. So make sure and get in touch with me right away if we feel like, that's not going to be able to happen this week, because that would be my focus if I were you, is to go back and make sure and get everything caught up to date. Okay? I'm sure you're working on it. but just that as a reminder. Okay, so we're going to look at 8, 10, and 12. 8, 10, and 12 have a consistent theme. Obviously, it's corporate finance, but the consistent theme through these three chapters really has to do with the market, capital markets in general, and how companies raise funds and make decisions based on financing through the stock market, using capital financing that has to do with raising money through the stock market. Now, I want to back up a little bit and kind of go over some of the fundamentals of how the market works before we get into more specifics within these chapters. And really, when I say more specifics, like I say, there's just some key points that I want to make sure and emphasize. There are way too many slides for us to cover all of them, and we're especially not going to cover many of the examples or math associated with those examples. I feel like that's something that you can do on your own, and that we don't need to spend too much time tonight on, because the short answer questions, even with the chapters that you need and the test, don't require a lot of that this week. So why do companies, first of all, ever need to finance projects? Okay, so maybe that's question one that we need to make sure and feel comfortable with. And then two, why do companies ever go to raising money through the stock market instead of just borrowing money from a bank, right? So when you and I think of needing money, for a mortgage or for a car or something like that, we usually just go to the bank and ask for a loan. And really, there aren't very many other opportunities for you and I as individuals to get access to cash. Even as a small business owner, it's the same is true. Small business owners really don't have many opportunities beyond going to a bank and applying for a loan to get access to capital. But public companies and large companies, even large private companies, have access to a lot more funding sources. They can get private equity money, venture capital money. There's a lot of resources, private investor money. They have a lot of resources to get access to capital, and one of which is just to sell their company, right? That's one way to access a lot of money if they're looking to just sell out, and they can do that to multiple, different channels. But that's one way to get capital. But another way to get capital for a small business owner or a business that's rapidly growing is to get to a critical mass where they can begin to access what we refer to as the capital markets. And the consistent theme through 8, 10, and 12 that we're going to be looking at this week is accessing the capital markets, why companies would do that, and then what the implications of that are. And there are a lot of implications of being a public company, first of all, having to disclose and give public financial statements we talked about last week. But more importantly than even those financial statements is it's the initial access to capital. That's the whole reason that most of them go public. Meaning, at some point, they make a decision that in order to grow their company the way they want to, the only way they're going to be able to do that is to access capital, the capital markets, either through raising money through bonds, where private investors and investment companies buy their debt, or through accessing the stock market, where they issue stock, they issue shares, they allow people to buy those shares of ownership of their company, some kind of partial ownership, which is all worked out through an investment, in some kind of investment company. Usually it's like a big investment company like a JP Morgan Chase or, a Barclays or a Goldman Sachs or a Morgan Stanley that comes in and helps them determine, how much demand there is in the marketplace for their company ownership, and then how much they can charge for that company ownership and what percentage of company ownership they should give up. A lot of times when they go public, they're finally willing to kind of unleash the company as far as the financials are concerned, but also from a control standpoint. Usually you're going from a handful of owners to then thousands or even millions of owners, and might retain 5 or 10% ownership, and that might be the majority ownership as far as the company is concerned, as far as the person with the most shares. So for example, when the owners of Google went public, some of the founders kept enough shares to be very, very powerful within the company, even though they only owned maybe 5 to 10% of the company after they went public, because they relinquished a lot of their ownership. Even that 5 to 10% ended up giving them a lot of power because nobody else had that many. And ownership based on shares comes down to voting for the board of directors, and the board of directors then makes the decisions on the executives, like we talked about in previous weeks. And so whoever has the most shares, or even whoever has a lot of shares, has a lot of ownership control when it comes to getting the board of directors that they want, and in turn getting the board of directors to make decisions for executives that they would like to see happen. Okay, so I know that sounds kind of convoluted, but the whole point of 8, 10, and 12 is talking about capital markets and specifically accessing stock and using stock to grow a company. So a company like Nu Skin in Utah is a big supplements company. It's a multi-level marketing company based out of Provo, Utah. Years ago, they had the opportunity to grow internationally at a very significant pace, but didn't have the financial backing, didn't have the money to grow the way they would like to. So they went public. They took their company public. The original owners sold out of a bunch of their shares and allowed other people to buy in to the company. And so you had owners being able to sell out of their shares and make money, but you also had money coming in that gave the company the opportunity to grow a lot faster and to have the finances that they needed in order to grow at a rapid pace. Okay, and every company that's ever gone public, that's the consistent story. They're accessing the stock market. They're accessing investors to buy shares in order to, one, give them some liquidity as owners, to get out of the company, or to cash out, or to get cash for all their work. That's the way that they get bought out. But two, it allows the company a firmer footing as far as rapidly growing and having access to capital markets for the financing portion of what they're trying to do. Okay. All right. So that's the high level. Now, a little bit, of an offset from that. When we talk about what the stock market is doing, Cayenne, we're talking about what stocks are doing based on people trading them back and forth. So when we talk about stock exchanges and we talk about stock trading, some people say, why is it called stock trading? I'm just buying or selling stocks. Why is that trading? Well, it's called trading because somebody else has to be able to sell those shares to you, or you have to have somebody to sell your shares to in order for you to sell or buy shares in the stock market. So there is always an exchange going on. One person selling, one person buying, and that's the only way it works. You're only going to be on one side of that equation, so it always just looks like you're either buying or selling your stock, but somebody always has to be lined up on the other side, ready to buy or sell, or it wouldn't even happen. Okay, so if I go into my E-Trade account and I want to buy Microsoft stock, if nobody out there was willing to sell Microsoft stock, I wouldn't be able to buy Microsoft stock. Okay, and there are small companies where that's the case, where there aren't shares available for purchase, or there's nobody willing to buy the shares. So even if you went to go sell your shares, nobody would be there to buy them. Okay. The nice thing about how efficient the stock market works, though, is that if I were to price my shares that I'm trying to sell down far enough, there'd usually always be somebody willing to buy those shares at some price. And the same is true for the other way around. If I go to buy shares and I go in and try to buy shares at $20 a share, nobody might be willing to sell me at that price. But if I go up to 25, there might be a lot of different sellers that are willing to sell their shares at that price. But it's always an exchange. It's always buyers and sellers, individuals buying and selling, investors buying and selling those shares from each other. Okay, it's not companies. One of the big misnomers when I talk about the stock market is that people think that when I go and buy Microsoft stock, I'm somehow buying from Microsoft, the company, and then helping Microsoft by buying their shares. Buying Microsoft shares on the stock market does not help Microsoft at all. Okay, because all I'm doing is buying those shares from another person, and Microsoft has nothing to do with that process. Okay, when I go and buy shares in my E-Trade account. The only time the company benefits is when they have these issuances, like an IPO, initial public offering, where they have their shares, and when they first go public, they sell the shares to the public through an IPO, or initial public offering, and then from that point on, they're exchanging from investors. Okay, investors are buying and selling. It's not me buying them from the company. The IPO is when investors buy from the company, but that only happens usually one time for a company. At one point, they have their initial public offering, and then from that point on, those shares are exchanged between investors. They don't have anything to do with the company from that point on. Okay? All right, so that is kind of some background on the stock market. A little bit of background on why companies are looking to the stock market to raise capital. And a little bit about the process. You've got the primary market where companies are selling their shares, and that's in the form of IPOs or initial public offerings. That's when it does benefit the company when I buy shares. And then you've got the secondary market through exchanges like the New York Stock Exchange where investors are buying and selling shares from each other. Okay, that's why we call it stock trading. You always have a buyer and a seller, and we're not interacting with the original company at all. So I buy Apple stock, I'm not interacting with Apple, the company, at all. Those are shares that were already offered years ago in an initial public offering by Apple, and now we're buying and selling among investors in the secondary market. Okay, so that's a little bit of the background on capital markets and stocks. Let's look at some of the slides now and see what we can see. I think I just skipped some stuff here. Yeah, I did, because I accidentally tapped on the hyperlink. So let me get back to the beginning. Okay, we can skip our objectives like we usually do and go right to the beginning. We've got some terms to define here. When we talk about capital budget, capital budgeting, and incremental earnings, it describes them here. Capital budget just lists the different investments that we're going to undertake. Capital budgeting is the process where we analyze these different options that we can invest in and decide which ones we're going to accept. Okay, and that's where a terminology that we've talked about before, net present value, okay, NPV of a project, comes into play, and the IRR, which is the internal rate of return, right? So we look at the NPV, the net present value, and the IRR of these different projects, and then we determine which one has the highest NPV in conjunction with our timetable, which that's where IRR comes in. And whatever one has the highest NPV in conjunction with our timetable, that's the best decision for our company. Now, sometimes it's not mutually exclusive, right? We have a pile of money that we can use to invest in projects going forward as a company, and there might be 10 projects that we accept and 30 projects that we decline as far as options and alternatives to our budgeting. Just like you and I as individuals, every year, if we were to run a budget, right, we have different choices that we can make. We can buy a car and take on a loan, or we can use our cash to buy a car outright, or we can use credit card debt to do different things that we want to do, or we can go out to eat more or go out to eat less. And those types of decisions all will have, in the end, a material impact on what we're doing. They may seem like smaller decisions at the time, but they all have a material impact on our finances, just like these decisions and budgeting decisions for a company do. Now, a lot of times people look at capital budgeting and they say, capital budgeting is just about cutting costs. When we talk about capital budgeting, we're talking about the exercise of, okay, we've already gone through the process of budgeting, which is the cost cutting and cost analysis piece. Now we're looking at what can we do with the funds that we have in order to grow our business. Because as we talked about before, the management decision rule or the valuation decision rule for companies is managers are to make decisions that maximize value for their shareholders, right? For their managers, for their business. And the process of capital budgeting is going through different options that we can use our budget for, our resources for, and finding the ones that will maximize value to our business. Okay. Incremental earnings have to do with kind of a pro forma situation. We talked about pro forma a little bit. We'll talk about a little bit more this time in these chapters that we're talking about. But pro forma basically is saying, okay, based on the projects that we're going to do, this is what we think the revenues will be from them and the profitability will be from them. And so incremental earnings have everything to do with, okay, new projects that we're taking on and the profitability or earnings that will come from those projects. So incremental earnings, as we've talked about with pro formas as far as financial statements, has to do a lot with assumptions and guessing. They can be extremely accurate, or sometimes, based on how we did our work, to get to that point, and then things that we can't control, like how well sales go and how well product development goes and what the pricing of our inputs are. Those kinds of things just have to be our best assumptions. Sometimes they get knocked way out of whack because we just, something else comes up. So, for example, capital budgeting can say, okay, an example or analogy to capital budgeting could be, okay, this year we expect Alabama to be excellent because Alabama as a football team is almost always excellent, right? So we rank them number one, and they beat up on USC, so we called it right? So there are a lot of prognosticators that are saying, see, we told you that Alabama was going to be that good. And we told you that USC was like the 20th ranked team before the season started. And that's kind of what they looked like coming into that first game when they played each other. But then you have prognosticators that called, and said, and told us that Oklahoma was going to be excellent, which they very well might be still, but they got beat up pretty good in the first game. And so now you have prognosticators saying, hey, that was our best guess, and yeah, we were wrong. Oklahoma doesn't look as good as we thought, yada, yada, yada. So that happens every year, right? We make projections for different teams on how well they'll do, and some teams do better, and some teams do worse, and sometimes we get it where we call it pretty well, and we made the right prediction. And that happens in business as well. Things out of our control can happen, like in college football, a quarterback or a running back can go, and get injured. All kinds of different things can happen with a football team. The same is true for a project, and for a budget that we're trying to do. And we're just making our very best guesstimates based on all the tools that we have and all the information that we can gather. All right, so here's an example. We're not going to go through the specifics of it, but then it gives you a table of net income based on this new project. And there are a couple of rules about doing that we need to talk about. Okay, we're not going to go about this. We're not going to go over the specifics of the example, but I do want to go over and highlight some of the points that are very important about making projections when it comes to projects. Because one very important thing is that we are going to buy, $7.5 million worth of new equipment. And it's a cash expense, but it's not directly listed as expense when calculating earnings. Okay, those expenses are going to be depreciated on a ongoing basis, in this case over 5 years. So they take $1.5 million worth of equipment expense, and that's what you use as your annual expense associated with this project. Okay, so just an important concept of depreciable assets. If you have an asset that's going to depreciate over time or equipment, and you know how long the project's going to be, you're going to amortize that over a 5 or 10 or 15-year period, and we'll only expense the amount that we actually use of the equipment each year instead of expensing it all up front. Okay, so that's one rule about budgeting. Another rule about budgeting is the concept of interest expenses. And what we say here is that interest expenses are typically not included in our budgeting. And the rationale here is that the project should be judged on its own, independent of how well or how good our financing, how good we get the financing. Okay. Now, something to just keep in mind is if we're not going to calculate in interest rate expense when we're coming up with our NPV, or when we're coming up with the benefit of the project, the decision makers need to understand that if we're going to get a 15 or 20%, if it's going to cost us 15 or 20% on our money to get the capital necessary to do the project, we need to know that, right? And it needs to be taken into respect, even though the actual projections might not, the budgeting might not. We need to be able to back into those numbers and make sure and account for them, because if we're paying a lot for the money in order to do the project, that could blow up the project and make us have a negative NPV or negative IRR, which in that case, of course, we wouldn't be doing the project, right? If the profitability of a project is 5%, but it's going to cost us 20% to do it, and we didn't account for that because we were using a capital budgeting process that doesn't account for interest, which most don't, then it could get us into some trouble, right? So just something to keep in mind, that if we're looking at a company's pro forma, or if we're a manager of a company and we're looking at something the financial analysts have brought to us about a particular project, it probably won't account for interest expense, and so it's something that we need to bring up and discuss and make sure that we understand what that expense is going to look like. We always look at taxes. Okay, want to make sure that taxes are part of it. We get some more examples. And then we get to the concept that you've probably learned about a couple different times, Cayenne, called opportunity cost. And what it comes down to on opportunity cost is the cost of making a decision based on the other alternative decisions that we could have made with those same dollars. So for example, if you and I choose to go to McDonald's and pay $10 for lunch, because we want something convenient and we want to go out to eat, that same $10 could have gone to our retirement plan, could have paid down debt, could have done all kinds of different things, right? We made the decision to, get some McDonald's for lunch, but there are all kinds of opportunity costs associated with that $10. Usually what we want to do as a business when we're making that decision is come up with the highest opportunity cost and make sure it doesn't exceed, right, the benefit associated with what we're doing. So if there's an opportunity cost associated with a project that we're working on that exceeds the benefit that we're going to gain from the project that we've decided to execute on, that would mean that we've made the wrong decision and we've budgeted incorrectly. We should have gone with whatever that other opportunity was and that's what we're referring to as our opportunity cost. Okay. Most times a project will have all kinds of different opportunity costs because there are all different kinds of elements and components of any given decision, right? It affects a lot of different things. We've got something that's very important to consider that's referred to as project externalities, one of which is cannibalization. Okay, so we put a bunch of new money into a project and we're trying to get incremental earnings. One of the things that we don't see many times in our project is how much we're going to lose in existing revenue and existing sales based on a new product or based on something new or something different that we're doing. So let's talk about that a little bit. Let's say I own a Kneaders franchise location here in Utah. Kneaders is a restaurant that does baked goods, does sandwiches, just kind of a cafe style, but then has a lot of baked goods and is well known for their baked goods, desserts, pastries, those kinds of things. So if I go into Kneaders and I have a franchise, I own one in Provo, and I say to myself, wow, this Provo franchise is doing really, really well, right? So I've got some capital to be able to do something with, and what do I want to do as a franchisee? Well, I want to open a new location. And let's say I have the rights to all of Utah County, which in Utah would include, 4 or 5 other cities. Well, there's an issue of cannibalization if I go and open another Kneaders, 10 minutes away in a neighboring city. Why? Because if I open a neighboring city, with my Kneaders location, I'm going to have less sales at my existing location, right? And because of that, I've got to change the numbers as far as my budgeting process across the board. First of all, my new location might not sell as much as my existing one, right? Because I'm taking business away from my existing one. But secondly, my existing business might not do as well going forward. So I got to be careful about that's an effective cannibalization on the budgeting process. I need to make sure that cannibalization is reflected in my pro forma or my numbers that I expect from my new project. In the case of a new franchise, there's ways to try to estimate that, but we're just making our best guess, right? We never know for sure the impact of a different location as far as on current sales and on the new location. Sometimes, and this wouldn't be something that you would ever expect, but sometimes there isn't an impact. In fact, the new location does just as well as the old one and everything goes forward without any problem. But it's probably more realistic to assume some level of cannibalization when you're opening a location that's fairly close. The same is true for new product development. If I come out with a new product, let's say I manufacture snowboards, and I'm going to spend a bunch of money and come up with a new product, I'm really excited about how well it will sell. Well, I also should be concerned with how it's going to change the revenue and sales on my existing products, right? Not that I still shouldn't go forward and do it, but I need to be careful that I understand how it's going to impact the sales on the current products that I have. Then it gives us an example, same thing. Then we get to a concept called sunk costs, and this is another finance principle, corporate finance principle that you may have heard of multiple times before. I'm not going to spend a lot of time on it, but it should be highlighted. Sunk costs are costs of a project that would have happened either way, and so they're usually not even included in incremental earnings analysis. So when we're budgeting a new project, let's say we need to budget for the fact that we're going to have utility, lights on in our warehouse, and we're going to have a lease for our warehouse, and we're going to have insurance on our warehouse, and we're going to have a certain amount of employees that we're going to be there either way. All those things are fixed costs that already exist regardless of us doing the new project or not. Now, there will be incremental costs over and above the ones I just mentioned that are not sunk, right? There are additional costs that would happen only if we take on the new project. But any costs, even if they're used for the new project that were already going to happen regardless of the new project or not, those costs we leave out of our incremental budgeting and the earnings analysis. Okay? And, that something like turning the lights on, something like the plumbing, those kinds of things at a building that we own. If we're just doing one project, at our location, those are all sunk costs because those were all going to happen regardless of a new project or not. And then fixed overhead expenses, of course, that we already know about. Research and development, money that we've already spent on R&D or research and development is a sunk cost again. So even if we've already gone down the road with a project as far as research and development, we decide to make a change in what direction we're going, we don't encumber a new analysis, for a new project with that old research and development, even if it's going to help, our new project, because that's gone and done and it doesn't matter going forward. Whether or not we move forward with a related project or not, that research and development cost is already sunk, or as we refer to, or it's already done, and so there's no reason to look at it. Another externality that is important to think about and to realize is going to happen is the effect of competition, right? So we already know that cannibalization will happen, and we need to, look at the impacts of that for our own product lineup. But there's also the issue of, if we come out with new products, other companies are going to probably be coming out with new products as well, and the competition may either help our product do better, or it might help our product, or maybe a better way to say, be a detriment to our product and make it do a lot worse. So, for example, if I'm Samsung, right, and I'm coming out with a new Galaxy phone, right? And then you've got Apple with their upgrades of their iPhones each year. Those two companies are kind of in an arms race, right? It's always Samsung versus Apple trying to come up with the best new smartphone with all the best new features. Well, any given point, Apple could come out with a new feature that just blows the socks off Samsung, and they do much better. Or Samsung, could come out with a new feature that is just so far and above anything that Apple's done that can make Apple's new release fare much less less well than they expect as far as their budgeting is concerned. So these big companies, both Samsung and Apple, are always doing analysis. They have teams of analysts, financial analysts, which is something you could do, Kyan, with your degree. You could become a financial analyst within one of these big companies and go in and basically just crunch numbers day after day and try to analyze the best case scenario, the worst case scenario, and then the most probable scenario, which is somewhere probably in between, and the impact of competition on that scenario. So people who are analyzing stocks are doing this all the time. They'll look at a new product from Samsung or Apple, or you name the company, a new product, and they'll say, okay, we think that the impact in the marketplace of this product is going to be X, and it's just their best guess, right? Based on competition, based on cannibalization, based on features of that product, and then we all get a few weeks into it, and then we decide whether or not those analysts were right or wrong. But it still is helpful information in evaluating a project and helpful information in evaluating an investment. Okay. Okay, so the bottom line, though, is when we do these performance, a lot of times we project out, something consistent, something nice, a nice chart that shows increasing sales each year, or it shows, stable sales each year from a new product. And reality is, we know that in the real world, sales are going to change from year to year. The average selling price is going to change. Average cost per unit is going to change. And so all these different moving parts are going to have a material impact on the profitability and earnings associated with a new project. And so our guesstimate as far as what we thought a project's going to do is probably going to be wrong, meaning we're not going to probably get it right, perfectly. What right is going to be is it's going to be within some margin of error, that we were mostly right. Either it was a little better or a little worse than what we guessed. What we don't want is something significantly worse, right, than what we guessed. And we actually don't even want something significantly better than what we guessed, because then it means that we're not going to be ready for that financially. Because as we're going to talk about a little bit later, or even if we don't, the book does, we have to budget right out a ways. And if something does very well, we need to be able to budget to be able to meet the demand. And if we have under budgeted for the demand, then we can't take advantage of opportunity, within that product that's in front of us. And some competitor might take advantage of that, copy our product, and sell the product that we didn't have, enough to sell. It'd be like if Apple came out with a new iPhone, there were significant demand for it. They sell out within a few days. And then you've got a group of folks who are ready for an upgrade, right? Excited to upgrade to the new technology that's there. And if iPhone doesn't have a phone available for them, that opens the door for competition to step in and for competition to take some of those customers away from iPhone, okay, or from Apple. All right, going more down the same road of that example that we saw. Like I say, you'll have those slides and can look at those. Incremental effect of a project on a firm's available cash flow is its free cash flow, right? So when we take on a new project, when we budget for a new project, and it actually does create the incremental profitability that we had expected that project to create, that creates free cash flow for a company. And when we talk about a company's balance sheet, financial statements in general, free cash flow is king, right? Cash is king. We want significant free cash flow, which is cash flow that's unencumbered by debt, unencumbered by obligation. It's cash flow that we can use to either pay our shareholders, okay, and increase value for our shareholders in the form of dividends, or, and most commonly, The free cash flow is used to then turn around and grow our business even more, enhance existing projects, or explore new exciting projects to increase profitability. Okay, we need that cash flow though in order to be able to do that. We already talked a little bit about depreciation. We're not going to look at that. Net working capital is an important finance concept. It's probably one that you've already looked at when it comes to corporate finance. We've got, when we look at the net working capital equation, and this isn't very difficult, so we're going to go into it a little bit. It's just current assets versus current liabilities. That's all it comes down to. And we got to have enough net working capital at any given point that we can take on projects, right? We have to have working capital to be able to take on projects. And so working capital is the cash plus inventory plus receivables minus payables. Okay. So a lot of times we have to increase cash or inventory and receivables in order to accomplish growth. Okay. So when we take on a new project, a lot of times that'll increase, we'll have to increase our working capital. Okay. How do we increase our working capital? Usually that's through accessing capital markets like we talked about, stocks or bonds, one way or the other, the bond market or the stock market, or by having lending agreements, borrowing agreements with banks, kind of back to that traditional form where we can borrow money as needed to increase our working capital. And then also there's always the opportunity to just increase receivables versus payables, right? If we can decrease payables and increase receivables at any given point, that also is a way to increase our net working capital. Okay. So net working capital has to change with increase in sales. We're going to have an increase in net working capital if we're going to have an increase in sales in most cases. So this goes through the math on it, looks at lots of different options. So when we launch a project and it produces a positive NPV, right, that's a good project. If we don't launch the project, we have a zero NPV, so it's probably worth launching the project to get that positive NPV. Always looking to grow value of a company as a manager, and the way we grow value is increase free cash flow, like we talked about. Cash flow is king. That increases value of the business. That is value that we can return to shareholders or invest in new projects and grow our business. So how do we increase our free cash flow? We invest in projects that have a positive NPV, because a positive NPV means that net of current cost, we're going to have current value benefits associated with that project. Okay, remember we have to account for time value of money, and we have to depreciate the benefits down the road, or discount the benefits down the road by the time value of money, or we're not really evaluating that project the way that we should. Okay. All right, so I think that's what we want to cover from Chapter 8. We've used most of our time, but let's look at Chapter 10 briefly. If I can pull it up here. Get it full screen. Get us on the same page. Okay, we should be looking at Chapter 10 now, and risk pricing, which is an interesting concept that should always be evaluated. A lot of different slides. We're not going to get to them all. But one of the things that the book starts with on this one is how stocks have changed over the years. And why does this even matter? Why are we learning about what stocks have done and what the stock market has done? I think what the book is trying to do here is twofold. One is the stock market has been a very successful institution in the United States, specifically. Some other countries not so much. But it's been a very successful institution in the United States for helping capitalize companies over years and years, but it's also been a win-win for investors. Okay, so the reason that the stock market works so well in the United States and capital markets work so well, and that there is funding for new companies as they come public, is because the public trust is intact. Meaning we trust that if we invest in a company, that over time they're going to increase value for us. If we didn't trust that, or if we had a track record of the stock market not doing well, then there wouldn't be, capital markets wouldn't even exist. Companies would only be able to grow by borrowing money from banks. But capital markets exist, and there is trust because by historical standards, the stock market has been very successful. So what would happen if you put $100 in different investments? The chart here shows you $100 over the last 80 years, which most people aren't 80-year investors, but it still is an interesting exercise. If you invested in small company stocks over the last 80 years, that $100 that you originally invested would have grown to $2.6 million. $100 without adding any money to it would have grown to $2.6 million over the last 80 years. Okay, that's small company stocks. S&P 500 would have turned into 275,000. A world portfolio that was diversified throughout the world would have ended up at about 120,000. Bonds would have ended up at 20,000. Treasury bills 2,000, and the CPI, which is basically the rate of inflation, would have been at $1,261. Which still, you're going from $100 to $1,200. That's a significant increase. But when we talk about small company stocks and money that's invested in companies that are growing rapidly in the form of IPOs, that is a significant return, obviously, going from $100 to $2.65 million. Okay, interesting chart. So this is why investors invest in the stock market. This is why investor trust is intact when it comes to new companies that go public. And that doesn't mean that everybody in the public trusts the stock market. A lot of people that I talk to as an investment advisor tell me all the time, hey, I don't trust the stock market. I don't want anything to do with it. It doesn't matter that there's 80 years worth of history to show that the stock market does well. I think that, I don't believe in it, and so we'll invest in something else. The only reason I show it to you is because the only reason that companies are able to go to the stock market and have initial public offerings and raise millions and millions and sometimes billions and billions of dollars from the stock market each and every year is because in large, in general terms, the market, okay, investors have a trust of the market that those investments that they make will go up. If they didn't, no one would invest, okay? If we didn't trust that the market would go up over time like it has historically, no one would invest, and there wouldn't be a stock market to invest in. And there are a lot of countries who are still very, very fragile as far as their stock markets because in the past that trust has been breached, meaning the stock market's fallen apart, companies have lied about what they were doing, they've gone belly up left and right. And if that happens in mass, then you have a situation where the public doesn't trust the stock market. Companies can't go public and raise the type of money that they can, like they can in the United States because of our track record. Now, that doesn't mean that there aren't bad apples. We've had a lot of bad companies over the years that have lied about their stuff, but in mass and in the aggregate, the stock market has been something that has, you're able to trust over the last 80 years will go positive over time. Doesn't mean that any given year it won't go down, but over time it's been a positive and very positive investment actually based on that chart we just looked at. And of course, this points out the obvious. Few people make an investment for 86 years like that chart shows. Most people's time horizons are much shorter. And if you've got a shorter time horizon, obviously, then you can have a situation where your value of your stocks might not do very well. Okay. So here's some different examples of stocks not doing well over different periods of time. But when we talk about, what markets might do, we talk about probability distributions. And this just goes back to your statistics classes if you've had them, Cayenne. We talk about distributions over time, we talk about bell curves, we talk about probabilities, right? And it's probable that if you invest in companies over the long term that they'll go up. That's what's happened historically. That's what happens the majority of the time. But there are circumstances when you don't, right? When you don't have a good return, right? And this particular distribution shows that about 25% of the time there's a negative return. And about 50% of the time it's decently positive, and 25% of the time it's going to outpace your expectations as far as being significantly positive. These are all statistics terms. I don't need you to understand all of them, but the basics you should have a kind of a general idea about. We talk about a bell curve, and that's pretty basic statistics. Talk about variance from, we talk about the variation from what we expect. We talk about standard deviation. We talk about the risk and distribution of a different outcome. And when we're talking about budgeting, it's really important that we understand that risk and probability of different outcomes, because we want to know what the likelihood is of something other than what we project happening, right? If I'm a business decision maker and you come to me as a financial analyst and say, hey, this project has the potential of doubling our money. We definitely have to do it. It has a strong positive NPV. I'm going to say, great, great, great. That all sounds good. Now, what is the chance, okay, according to your numbers, that this project could go belly up and we could lose money on it? Okay, and if you tell me based on your numbers that the probability of that happening is 30%, I'm gonna weigh that. I'm gonna say, okay, so there's a 2/3 probability that this is going to go well, and a 1/3 probability, according to your numbers and projections, that this might go belly up and lose us a lot of money. My next question is, how much would be the worst case scenario? You know, how much of a loss would be worst case scenario? And I have to measure, as a financial decision maker, that worst case scenario and the probability of something bad happening against the potential benefit and decide. That's why I get paid the big bucks if I'm a financial decision maker or an executive of a company. I got to make that decision. Then I got to live with it, and I'm going to get fired if it goes too poorly, right? That's just how things work. Because if I'm the one at the top making the end decisions and I'm the one with the power, if some things go wrong, the buck stops with me. Just like a head coach, college football. College football just started, right? The reason that a lot of head coaches don't stick around for very long is because they're the ones in the end that have to make the hard decisions. And if those hard decisions end up with losses, then they're going to lose their job. Okay, that's just how it works, and that's how it works in corporate America as well. If you're the CEO getting paid the big bucks and you lose a game or lose, you know, a lot of different situations as far as financially they come out wrong, and you end up losing a lot of money, then you're going to get kicked to the curb. You're going to lose your job. Okay. All right, I think that's all we have time for tonight as far as these are concerned. Lots of examples, once again, for you to review and situations for you to review, but they kind of get in the weeds as far as the information and statistics and calculations, and we don't have the time for that tonight. Okay, so let's back up a little bit and take a few minutes to cover the test. Didn't get to chapter 12, just make sure you understand that the test is covering chapters 8, 10, and 12, just like the assignment does, so that should be pretty straightforward, but just as a reminder, that's what we're looking at. 8, 10, and 12, the test is 25 questions long, and let me give you some feedback on what will be on the test. As I mentioned, there are 25 questions, some of which are true and false, some of which are fill in the blank, some of which are multiple choice. Okay, and worth 2 points apiece for a total of 50 points, not as much as last week and not nearly as much as next week's test. There are no repeat questions like there were on last week. It's not a comprehensive test. It's only over chapters 8, 10, and 12. Here are some of the topics that will be on the test. So one of the things that we want to understand for the test on number 1 is what capital budgets are. We talked a little bit about what capital budgets are, but you're going to want to understand what they include and what they don't. Okay? What do capital budgets include and what do capital budgets not include? And then what is the process of capital budgeting? Okay? What is the process of capital budgeting? What do we use when we are budgeting, okay, going through the capital budgeting process, at least according to chapter 8 in the book? What do we use for that decision making? Okay, what do we use to make decisions when it comes to capital budgeting? Okay. Number 3 on the test. When number 3 on the test, we want to understand how we would evaluate manufacturing process improvements. Okay, so if we have a project to improve the manufacturing process, what types of numbers are we going to want to look at? What does the book tell us? What are the outcomes that we want to look at in order to understand whether or not our improved manufacturing process is working or not? Okay, just make sure you understand what the book has to say about that, because there are some things that you would want to look at, and it's pretty intuitive, and then there are other things that don't make sense to look at, right? If I am going to improve my marketing team, okay, and my sales force, it makes sense to look at my sales, right? If I improve the team and put money into the team, I should be able to see a resulting increase in sales. If I improve equipment in my manufacturing process, it's probably not going to change sales, but it might improve my productivity and my output, right, of my manufacturing. So just keep that in mind. There are different things, you know, based on the project that we're going to want to look at and be able to determine whether or not that was a successful project or not based on those outputs, okay? And each project is going to have different outputs that are going to be helpful in helping to evaluate whether or not it was a successful project or not. Okay, so one of the things on chapter 4 you're going to want to understand, we went through together some of the different things that we leave out when it comes to the incremental budgeting process, okay? So there are different things that we leave out. There are different things that we are careful to include. One of the things that we leave out that we discussed in chapter 8, well, there are a couple different things. You'll just want to know which things in traditionally, okay, it doesn't mean we have to leave them out, but traditionally, what do we normally leave out of the capital budgeting process, and what do we not really account for in the capital budgeting process? There's a question number 4 that's going to ask you what things we don't include. Number 5 is just asking you to identify operating expenses, what, operating versus non-operating expenses. So we got fixed costs that are non-operating expenses, then we've got operating costs. And the book goes through that in chapter 8, and you'll just want to know the difference between those and be able to identify an example of an operating or non-operating cost associated with a project. Number 6. Again, the assumptions associated with capital budgeting. Some things we know are going to change, but we don't assume that they change. Okay? So what does the book talk about as far as examples of things that we know change over time, but we can't really estimate how they'll change or what direction they'll be, so we keep them consistent or constant for purposes of our projections. Some examples of that, if you know those, you'll get number 6 right on the test. Number 7 on the test, we just want to know that you understand what a geometric return is. What is a geometric return? So this is stuff from chapter 10, if I'm not mistaken. Number 8 on the test, you'll want to know volatility, when we talk about stocks, small companies, large companies. This kind of goes back to that chart we looked at. If you recall, small company stocks had the highest return over the last 80 plus years. But they also, something that the chart points out, had significant downturns and significant fluctuation and volatility. So just keep that in mind for number 8 on the test. Number 9 on the test talks about rational investors, what they expect from their investing, how they think. Make sure you understand, and I think this is once again chapter 10, you want to understand what rational investors think when it comes to their investments, what the book has to say about rational investors. You want to understand for number 10 on the test the difference between the stock market and treasury bills. So which one's higher volatility, which one's higher returns? Stocks versus treasury bills. What does it mean for a company to be leveraged? What does it mean for a company to be leveraged? What does leverage mean? If you understand those two things, you'll get 11 and 12 right. What is leverage? What is a leveraged company? Number 13 on the test. We want to know about the cost of equity. So when we're trying to establish our cost of having to raise money through equity or raising money through the stock market, we want to know the difference of after-tax and pre-tax cost of equity. Okay, is it the same? Is it different? Is it higher? Is it lower? The difference between after-tax cost of equity and the pre-tax cost of equity. Okay, so when we talk about accessing the bond market, bonds have an after-tax cost that's actually better than their pre-tax because we can write off some of the interest associated with the bonds. Equities don't have that write-off from a tax planning standpoint. Okay, so if you understand the difference there and understand what the book has to say about pre-tax versus post-tax cost of equity and cost of bonds, you'll get number 13 on the test right as well. Number 14 on the test, you want to understand about what the yield to maturity is for a company. The yield to maturity is the price of their debt. Okay, yield to maturity is just the cost of the interest associated with debt or with bonds associated with their company. So if Microsoft issues some bonds and they issue them at a 5% coupon and it ends up being a 5% yield to maturity, that 5% yield to maturity is the cost to Microsoft for issuing those bonds. That's the money they have to pay back to you and I as the investors of their bonds. Okay, so yield to maturity ends up being the cost to a company for having bonds. Make sure you understand what the WACC is, what the WACC is, or the weighted average cost of capital. What is it? What does the book have to say about it? There's a few questions, both 15 and 16, that have to do with WACC, or the WACC, what I refer to just as an acronym as a WACC, which is the weighted average cost of capital. And you'll want to understand the ins and outs of that, what the book has to say about weighted average cost of capital, what goes into it, and how they come up with that number. You want to know what the basics of stock returns are, the fundamentals of stock returns. That's a Chapter 10 issue. So if you understand what Chapter 10 has to say about what we should expect from stocks as far as volatility, returns, those kinds of things, you'll get number 17 right. You'll also get number 18 right. You'll also get number 19 right. All three of those are about stocks and stock investing, about diversification, what the book has to say about large company versus small companies, about volatility, about potential returns. Okay. Number 20 on the test asks, how does the capital budgeting process begin? So just make sure you understand how the capital budgeting process begins. That probably is straight out of Chapter 8. So if you go back to Chapter 8, you'll find exactly what the book has to say about what you should do first, what companies do first when they begin the capital budgeting process. Number 21 needs you to understand what the ultimate goal of the capital budgeting process is. What is the ultimate goal of the capital budgeting process? The book will tell you in Chapter 8, this is the ultimate goal of the capital budgeting process. If you understand that, you'll get number 21 on the test right. Number 22 on the test, just need to define incremental earnings. What are incremental earnings? What does the book have to say about what incremental earnings is? Again, that's a number, that's a problem or an answer that you'll find in Chapter 8. Number 23 is about IRRs and NPVs, about decisioning as a business. Just make sure you understand the basics of NPV and IRR, and you'll get number 23 right on the test. Same with 24. 23 and 24, both IRR and NPV questions. Just need to know the basics of both of those, net present value and internal rate of return. Number 25 on the test, you'll just want to be able to define what common risk is. What is common risk? What does the book have to say about what common risk is? Okay, that's the test this week. You've got 25 questions, 2 points each, 50 points total. Now you've got the topics that you need to know for that test. Should be in great shape. Okay, I hope you have a good week this week. Good luck with the test. I once again look forward to seeing your work come in for this week and for last week. And once again, just get in touch with me if there's anything we can do to get you unstuck if you get to a place where you can't get moving forward. All right, have a great week. We'll talk to you soon. Thanks, Kyan. Have a great week. We'll see you.